Proudly brought to you by Investment Solutions with confidence.
I'm in New York City on a beautiful summer's morning. I'm in Central Park, which is arguably the most loved, most used and most cosmopolitan piece of public urban space in the world. It's 836 acres, 250 are lawns, 150 is underwater, ponds, lakes, etc. And there's 80 acres of woodlands. The locals I speak to say that Central Park has never been in such fine shape, which is in sharp contrast to the state of the US economy. The US economy, it's nothing new to say that it's running twin deficits, the budget deficit and the current account deficit. And what about the 17 trillion of national public debt? It's almost 17 trillion anyway, it doesn't matter. What's a trillion here and there between friends? And the US Federal Reserve? Well, the US Federal Reserve has a massively expanding balance sheet, a balance sheet that is laden with the debt of its own country. Does it all matter while the US is the world's biggest economy and while it controls the printing presses? Probably not, but we're going to find out.
In November 2008, just a few months after the collapse of Lehman Brothers, the US Federal Reserve introduced QE1, the first in what became a series of quantitative easing programs. It involved the Fed spending $100 billion per month to purchase mortgage-backed securities. It lasted 17 months, with a total spend of $1.7 trillion. In November 2010, the Fed introduced QE2, which lasted 7 months, with $85 billion spent on US Treasuries per month. A year after QE2 concluded, the Fed went even further by introducing, yes, you've guessed it, QE3. In a move seen by many as controversial, this program included a clause stating that a further purchasing of mortgage-backed securities and treasuries would go indefinitely, with no limit to purchases. The degree of spending remained static at $85 billion per month. Quantitative easing ran in tandem with Operation Twist, and quite aptly named, this introduced a different dynamic. Short-term treasuries were sold by the Fed, the proceeds of which were used to buy up longer-term securities. In January 2013, changes were made to QE3's structure, evolving it into what's now commonly referred to as QE4. Operation Twist had come to an end by this time. The Fed was to target the unemployment rate directly. QE4 would continue until this rate fell below 6.5% or until core inflation rose to 2.5%.
Over the next hour, we're going to talk to business leaders, to economists, to traders, to ex-traders, to academics, maybe even try and find a politician or two, who knows. But we're going to try and find out if money grows on trees. In Central Park, as you can see, quite a lot of trees. In fact, there's 24,000 of them. 1,700 of them are American elms, and they're looking particularly fantastic at this time of year. But there's no money trees. They're elsewhere. Let's find out if money really does grow on trees.
Government monetary policy occasionally used to increase the money supply by buying government securities or other securities from the market. Quantitative easing increases the money supply by flooding financial institutions with capital in an effort to promote increased lending and liquidity. Trying to understand quantitative easing seems simple enough on the surface, but scratch a little deeper and you'll find a slew of different opinions, with some for it, some against it, and some who just sit on the fence. Louis Alexander, most recently at the US Treasury Department, where he was counselor to the Secretary of the Treasury, and a few years earlier worked as a senior economist at the Board of Governors of the US Federal Reserve and at the US Department of Commerce. He's currently the chief economist at Nomura. We begin our search for the big truth on quantitative easing at his offices in New York.
Louis, there's quite a few misconceptions about quantitative easing, QE as it's called. Is it really the printing of money?
No, I wouldn't say it is. Actually, it's purchasing assets, and that has the effect of creating excess reserves on bank balance sheets, and in some ways of accounting for it, that is a form of money, but I don't believe it's generating inflation. I think it's primarily acting through the risk appetite of private investors. Effectively, what you're doing is you're taking risky assets out of private portfolios and replacing them with safe liquid assets. The natural response of investors on the other side in response to that is going to be go out and demand other risky assets, and that will have the effect of stimulating the economy. I do not think of it as primarily printing money.
Of course, everyone with even a hint of interest in the US economy has a view, albeit controversial at times, on the Fed's policies. Lee Adler, founder and publisher of the Wall Street Examiner, says it's all about looking at the data, blocking out what the pundits say, and finding out the facts.
Tell me about quantitative easing, tell me about printing money, and tell me about money growing on trees. What's it all about?
Well, all of the central banks are moving in the same direction at the same time. They are dealing with the same banks, the same clients all over the world. They are pushing policy in a direction that they've never gone before, where they're focusing on the direction of equities rather than the money markets themselves. And when you look at, for example, the 21 primary dealers that deal with the Fed, only 7 of them are U.S. banks. 7 are European banks. 4, I believe, are Canadian banks. 3 are Japanese banks. And they're the same banks that are dealing with the ECB and the Bank of Japan and the Fed. So it's all one liquidity pool. The central banks are pumping liquidity into these institutions, and they decide where it's going to go. Is it going to go into Japan? Is it going to go into the U.S. Treasury market? Is it going to go into Europe? Is it going to go into commodities? Or is it going to go into U.S. equities? And I think the answer is that the central banks are pushing, in particular, Ben Bernanke is pushing them to go into U.S. equities. That's where he wants it to go.
Who are these primary dealers?
Primary dealers are those very special banks and dealers that are selected by the Federal Reserve to transact trades with the Fed. The Fed conducts monetary policy by trading with these 21 dealers that have to meet certain criteria. And they include Goldman Sachs and JPM and Societe Generale and BNP Paribas and Mizuho and Daiwa and RBC, the Royal Bank of Canada, RBS, Scotland. All of these banks are worldwide organizations. They are operating in all markets. And as I said, only 7 of them are U.S. banks. So when Fed policy goes out, it goes out to the entire world, not just to the U.S. market. By the same token, the ECB, when it conducts business with the banks that it deals with, and when the BOJ pumps money into its system, it's going into the same banks. They decide where they're going to put that capital.
Blackstone Advisory Vice Chairman Byron Wien notoriously releases his list of top 10 predictions for the US each year. His 2013 list included these 2 predictions pertaining to the US economy. A profit margin squeeze and limited revenue growth caused 2013 earnings for the Standard & Poor's 500 to decline below $100, disappointing investors. The S&P 500 trades below 1,300. Companies complain of limited pricing power in a slow, highly competitive world economic environment. Financial stocks have a rough time, reversing the gains of 2012. Intense competition in commercial and investment banking, together with low trading volumes, puts pressure on profits. Layoffs continue and compensation erodes further. Regulation increases and lawsuits persist as an industry burden.
Is Mr. Bernanke giving us short-term stability but sacrificing future stability? In other words, is he creating something that is going to create even more volatility for us in the future, both market-wise and economy-wise?
There are a lot of people who think that. I'm not so sure that's right. Because after all, the kinds of things that you would expect to happen as a result of such vigorous expansion of monetary policy aren't happening. We don't see any evidence of inflation. Why? Because inflation is ordinarily driven by house prices and labor rates. Houses are going up modestly, house prices, and labor isn't going up at all. Average hourly earnings are hardly budging. So we don't see any inflationary effects. So everybody, all the critics of Bernanke are saying, oh, just wait. You know, we're going to have a serious inflation problem. Maybe, maybe not. He's been doing it for a long time now, and we don't see any evidence of inflation. So I'm a little skeptical. I can't help but think that all this monetary expansion is going to end badly, but we don't see any early warning signs yet.
Peter Schiff, an American investment broker, author and financial commentator, saw the housing bubble coming way before it burst. Our economy rests on the foundation of the housing market, and it's a very weak foundation. The housing market today is very similar to the internet market of the late 1990s. And look, it's not going to last much longer. At some point, the lenders are going to balk. The interest rates are going to keep on rising as more and more housing supply comes on the market. Eventually, at some point, the bubble's going to break. And now he's predicting a worse financial crisis than that of 2008.
Peter, let's go back to 2006. I was watching you on CNBC. You were chatting to the presenter and also to some rather bombastic and arrogant person in another part of America. And you were putting forward the idea that in 2006, the US was facing a housing bubble. And this gentleman literally laughed you off the set almost. But of course, then what happened was there was the housing bubble. It did burst, and then along came ultra monetary policy easing and also quantitative easing. And now everything's fine, of course.
Well, they think it's fine. And, you know, the same people who were laughing at me back then are still laughing at me when I tell them how much worse this next crisis is going to be because of all that cheap money. All the Fed accomplished with its quantitative easing and all we got from the bailouts was we delayed the pain. That crisis should have been a lot worse, but it wasn't because of what the government did and what the Federal Reserve did. But it's not without consequences, because by doing that, we actually exacerbated the underlying problems and merely postponed the pain. And now, unfortunately, because the problems are bigger, we're going to have a worse crisis coming than the one that we think we solved back in 2008.
On the other hand, people will say if we hadn't have done what we have done, then things would be even worse right now.
Well, I doubt they would still be worse. They certainly would have gotten worse at the time. But it would have been constructive pain because the economy would have been dealing with all the malinvestments, the misallocations of resources that were at the heart of the crisis. But the question is, why were resources so badly misallocated? It was because of the false signals sent to the market by the Fed. Remember, the artificial stimulus didn't start after the financial crisis. That's what caused it. We didn't have a housing bubble by accident. It was the consequence of the monetary policy the Fed used to get us out of the 2001 recession. They slashed interest rates down to 1%, and it was all that cheap money that went into the housing market that financed all the adjustable rate mortgages and subprime. We had a phony recovery. Now, had the Fed not done that, the 2001 recession would have been much deeper, but we wouldn't have had the housing bubble, and we wouldn't have had the financial crisis of 2008, and we wouldn't be staring at a far greater economic crisis that's around the corner.
Coming up, we go inside the New York Stock Exchange and continue our probe into the Fed's QE programs.
I work in Wall Street. I don't think a lot about morality.